When it comes to tax reform, Trump has repeatedly made a surprising promise to eliminate income tax altogether, and that'd be as big a deal as it sounds. Doing so would leave a $2.4 trillion hole in the federal budget. That's what Americans paid to the IRS in 2024. Half of all federal revenue gone. If Trump wants to get rid of it, he'd have to find another way to raise that money. And he plans to replace that lost revenue with tariffs. But could this really work? And how would getting rid of income tax transform the American economy? That's what we'll dig into in this video. Funding the government with tariffs is not such a far-fetched idea. Just look at this chart, which shows the different sources of revenue for the federal government. You can see that tariffs were the only source of government revenue until 1913, when income taxes were introduced. But they were largely phased out in the 20th century as globalization knocked down barriers to free trade. Until Trump's first term, tariffs were used sparingly, mostly as a punitive measure. And by 2016, the average US tariff rate fell to 1.4%. Trump's latest tariffs are projected to raise that to at least 11%, if not higher. But returning to a tariff-first revenue model is going to be tricky to say the least. Not only because of the country's appetite for cheap imports and foreign revenue, but especially because of how much the government spends each year. In 2024, the US government spent $6.75 trillion and took in $4.9 trillion, which means it ran up a $1.8 trillion deficit. And that's been piling onto a mountain of national debt that's grown to more than $36 trillion. That's why increased revenue and a balanced budget are so urgently needed right now, and tariffs are an option to raise cash. But even hefty blanket tariffs like Trump has promised likely won't fit the bill. This shows different estimates for how much revenue could be raised under different tariff scenarios over the next 10 years. Estimates range from $1.8 trillion to $4.3 trillion over the next 10 years. Even the highest estimate of $4.3 trillion would only bring an average $430 billion per year, less than a fifth of what income tax currently brings in annually, around $2.4 trillion. So, exactly how to get to zero income tax without throwing the US into a full-blown debt crisis remains an open question. But what's even the point? How would reducing income tax benefit the country and the economy? The common argument for reducing tax, or getting rid of it altogether, is that it's pro-growth. It's common sense. When individuals and businesses pay less tax, they have more money left to invest and spend. That should mean more people buying more things, more companies hiring more jobs, and generally a faster growing economy, leading the government to collect more tax revenue. We did see some of these effects following big tax cuts in the past. The Tax Cuts and Jobs Act in 2017 was followed by a surge in job openings. Job availability jumped by more than 1 million open jobs in the year following the tax cut. We also saw evidence of increased economic output following the tax cuts at the end of 2017. Actual measured GDP in 2018 well surpassed the CBO projections. In the second and third quarters of 2018, GDP was about $290 billion higher than the CBO's most optimistic projections. GDP growth then slowed in the final quarter of 2018 and 2019 as trade tensions with China increased. And that's the catch. Trade tensions and tariffs are not pro-growth. In fact, they slow growth. Consumer spending could see a 1 to 2% drop in growth in 2026 with tariffs, according to forecasts by Deloitte. That big drop in spending would weigh down the economy. Deloitte also projects that GDP growth will decline over the next few years as a result of reduced consumer spending. That being said, there is a potential upside to tariffs. They're designed to make the economy less dependent on other countries. Higher import taxes incentivize consumers to buy local and spur companies to build factories and create jobs in the US. So if tariffs do replace income tax, who are the winners and losers? The companies hardest hit by tariffs will likely be those who rely heavily on foreign manufacturing and foreign markets. Think companies that trade in hard goods, made largely overseas, particularly in China, like Apple, Nike, and Walmart. These companies are vulnerable to tariffs and will feel the pain on their balance sheets until they can rejig their supply chains, or score tariff exemptions like Apple has for smartphones, for now at least. It's not just manufacturing, though. Many American companies depend heavily on foreign buyers, and reciprocal tariffs from other countries will likely hurt those sales. For example, around 40% of revenue for the S&P 500 companies comes from outside the US. Now, as for how long this will take to play out, Trump himself has stated that any plan to eliminate income tax would take a while. So this is not going to happen tomorrow and probably not even next year. And these changes could start to be priced in even before income tax is ever fully eliminated. At Capital.com, we'll continue to keep you updated on the latest market trends and developments. Thank you for watching.